There's a famous quote: "A prudent speculator never argues with a tape." Last week's tape action was quite revealing. We're going to examine exactly what this all means for the markets and which stocks may benefit the most. And what we've uncovered may surprise you, but it has nothing to do with technology or AI. Last week, Monday through Thursday, we saw a counter-trend pullback. This is the S&P 500 on a daily chart. For the most part, it's been strong. Last week, Monday through Thursday, we saw a pretty sharp reversal. However, on Friday, big gains, making up all the losses for the past couple days. Here, the Fed funds futures, they moved also. Monday through Thursday, we saw the odds that the Federal Reserve would cut rates in September drop from the mid 80s down to 75%. But on Friday, the Fed funds futures surged. We now have an 85% chance the Federal Reserve in September will cut rates by a quarter point. So Friday's market action was very telling. We're going to show you several different markets to demonstrate exactly this. First off, stocks. Notice in particular the Russell 2000. That's a small cap index. That was the strongest of the day. This was on Friday. This shows us there's a real appetite for risk. Taking a look at commodities, gold and silver were strong, up 1 and 2.5% respectively. A real appetite for the hedges against inflation. In terms of the foreign exchange market, well, the story was the dollar was weak, sending the Aussie, Kiwi, pound, and euro, the yen, the CAD all higher against a weakening dollar, which makes sense because gold and silver were also strong. And then the bond market, well, yields were down. We're going to take a deeper dive into the bond market in just a moment and show you exactly what this all means. What caused markets to return to the primary trend on Friday? What changed? Well, the Dow gains as Fed Chair Powell opens door to a rate cut. This is from the Jackson Hole meeting. Now, he said a number of different things. This is a Federal Reserve speech published on August 22nd. In particular, in terms of the Fed's dual mandate goals, the labor market remains near maximum employment and inflation. Though still somewhat elevated, it's come down a great deal from its post-pandemic highs. This we all know. At the same time, the balance of risks appear to be shifting. Within the language of the statement, there is definitely a bias towards a shift in their opinion, meaning more leaning towards a rate cut. He continues in terms of the labor market. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharper, higher layoffs and rising unemployment. We've spoken about this dynamic in our jobs numbers recently. He also said, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside. We know that. PCE, CPI, they've all been hot. And risks to employment to the downside. Remember that non-farm payroll number? A challenging situation, to say the least. He also said, nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. So we have high inflation, low employment figures, but their bias is really shifting more towards a lack of growth, meaning rate cuts. But all stocks are not the same. Here are the different markets. First off, the VIX, the volatility index. Now it dropped from 1660, which is not incredibly high, down to 1422. But this is the lowest low we've seen not only in the past couple of weeks, but actually in quite a while. And there really is a lot to be taken out of the action of the VIX, how much it reacts to stock market movements. Stock market indices are made up with hundreds and thousands of different stocks, but the VIX really tells us the appetite for risk. And at the moment, with this huge drop down to 1422, it shows us that market really, once again, has an appetite for risk. Now, notice the nuance between the different markets. This is a Dow Jones Industrial Average. On Friday, closing at 45,632. Notice this is much higher than the prior couple weeks. So the Dow, which is a small index, only those 30 stocks, but it has no problem charging the new highs. The S&P 500, it's nearly or just about at new highs as well. The Russell 2000, that was the number one performer on Friday, 2362, in a healthy region of new highs. But the NASDAQ, this is the question mark. This is a divergence. And this, by the way, divergence is a theme, we're going to talk about. When there's a disagreement, pay attention to it. The NASDAQ is not able to perform the way the Dow, S&P, or even the Russell is. The NASDAQ is heavily weighted towards technology. Notice those AI stocks that once upon a time were the darlings, maybe not so more. Now, there's a message from the bond market as well. Here are the different maturities. For example, the 13-week, that's a very, very short-term yield, and the 5-year. And notice these two bonds have something in common. The 13-week Treasury yield dropped down to 409. That's a lowest low by quite a lot, actually, relatively speaking, in quite a while. The 5-year also at 376. That's basically at monthly lows. So the short-term maturities, which are more reactive to the anticipation of interest rates, they've dropped precipitously. The bond market, the treasury market really believes that the Fed is very close to cutting rates at least once, if not more. Notice the divergence between the medium, like the 10-year, that's at a 426. True, it dropped down to 433, but it's not at monthly lows. It's only at really 1-week lows. Notice the 30-year bond at a 488, certainly dropping down from 492, but it's still probably the third highest treasury yield we've seen in quite a while. So the short-term yields have dropped a lot. The long-term yields, not so much. And the longer we go out in the maturities, the less significant of the drop. This is telling us that the treasury market, the economy overall, is expecting over the long term that the economy will be healthy, that things are going to be good. In the short term, the 13-week or the 5-year, it shows us the anticipation of interest rate cuts. Pretty interesting, dynamic here. Now, commodities. Take a look at gold. And remember how we looked at the stock markets, the indices, the same way. Gold, 33.74, new high. Silver, 39, new high. So those hedges against a falling dollar, those hedges against inflation, well, they're in season. However, take a look at copper and crude oil, which tend, of course, move to some extent, against the dollar. But really what this is telling us is copper, relatively speaking, and crude oil are weak. That reflects a lack of demand or the anticipation that the economy, the industrial side of the economy, manufacturing, is not going to require as much of these raw materials. And that's the negative. We see the commodity markets telling us, yeah, inflation's coming, but manufacturing, economic expansion, maybe not so much. Now, there was some pretty interesting divergence in the ETF, exchange traded funds. The performance, particular on Friday, and in particular, notice XHB versus XLRE. XHB, that was up over 5% on Friday. XLRE, up only 1.5%. What are these ETFs? What do they mean? Well, XHB, that is a home builder. They specialize in building homes, things on companies like D.R. Horton and Lennar, for example, as opposed to XLRE. It's a real estate investment trust. They invest in a number of different projects, but they derive their income mostly from rent. XHB, the home builders, they specialize in new housing projects. XLRE, they rent out office space, industrial, retail space, for example. These are real estate projects they already own, and now they're charging rent for it. Now, XHB, the home builders, they benefit during economic expansions. That's where the real money is made. XLRE benefits from rental income. So the economic expansion is not quite necessary as long as the tenants pay the rent. And in other words, and to keep it very simple, the home builders, XHB, it's a risk on type of instrument. They do well, very well, when the economy is strong. XLRE, they don't do as well during strong economies, but it tends to be more resilient during weaker economies or economic contractions. The economy may be contracting and we may not see any new housing projects. We may actually see a housing crash. But as long as those tenants pay the rent in those office spaces and industrial and retail spaces, XLRE benefits. Well, again, during a strong economy, XHB, the home builders, they tend to outperform XLRE. In other words, during strong economies, the home builders do a lot better than the real estate investment trusts, who just charge rent. So we take this calculation, this is our own creation, by the way, and we subtract XHB, their performance, on a year-over-year basis minus XLRE on a year-over-year basis. And we call this the Builder-landlord index. How much better are home builders performing more than landlords? And logic dictates that during a strong economy, the home builders will be doing very well, better than the real estate investment trusts, the REITs. So XHB minus XLRE, our builder landlord index, should move in the same direction as the stock market. Well, that's exactly what we've seen from our testing. In red, S&P 500. Now that's the performance on a year-over-year basis. In blue, the histogram bars show us the builder landlord index, and we can see a pretty striking correlation. When the stock market performs well, the XHB minus XLRE, the builder landlord index, that also tends to perform well. And during economic contractions, when stocks go down, XHB underperforms XLRE. Now, the reason why we bring this up, and this was just a very fortunate coincidence, we just wrote about this, the Trading the Builder Landlord Index. This is in our Substack free newsletter. We'll provide a link in the description of this video. And we take into a consideration a lot of detail as far as how we calculate this and examples of how it can be used and where we stand currently, what the Builder Landlord Index is now telling us. So it's really a fortunate coincidence that Friday's trading action, XHB, was a number one performing ETF. And we'll continue to update you along the way with any pertinent information. We hope this has been helpful. We look forward to seeing you back soon.